All right, welcome back to the deep dive. You know how this works. We take something you're really interested in, some material you've been digging into, and we try to extract the core ideas, the real insights that matter.
Yeah, so you don't feel overwhelmed by all the details and you walk away feeling like, okay, I actually get this now. I
Right.
can use this.
Exactly. And today, we're diving into an article you sent our way, and it's called Seven Jewish Investing Tips During Turbulent Times.
Now, I know that title might sound, well, maybe a little specific,
Yeah.
but trust me, once we unpack these principles, you'll see how these ideas, they've been tested and refined over centuries, dealing with all sorts of instability,
Yeah.
and they offer some really relevant guidance for how we navigate the economy today. It's a little rocky out there, right?
It is, and you know what I found striking when I read this article was how timely these tips feel. Even though they have these deep historical roots, it's like they were written for this very moment. So the article lays out 7 core principles for investing, and we're going to explore each one, try to give you a clear path to building a resilient approach for managing your money, especially when things get a little unpredictable.
Sounds good. Let's jump right in.
Let's do it.
So the first principle is all about what the article calls Talmudic diversification. Now, this comes from a quote in the Talmud, which, for anyone who doesn't know, is a central text in rabbinic Judaism, and it says, "Let a man always divide his money into 3, a third in land, a third in business, and a third at hand." So how do we apply that wisdom, that ancient wisdom, to today's world?
Well, to me, it just seems like such a sensible, balanced approach, even in the 21st century. The article translates this into building a modern investment portfolio and making sure you have your assets allocated across different categories, different buckets, if you will. So that third in land, that resonates with what we might call tangible assets, stable assets.
Right, things that have intrinsic value. You can see them, touch them.
Exactly. Real estate is a great example, or
Right.
maybe investments in infrastructure, those essential physical structures that underpin an economy. It's like the foundation of your financial house.
Makes sense. The bedrock, yeah.
And then that third in business, well, that naturally evolves into what we think of as growth-oriented investments. It's your equities, your stocks and companies, maybe even private businesses if you have the opportunity. This is the part of your portfolio that's really aiming for capital appreciation.
Yeah, it's where you're hoping for some serious growth over time.
And then there's that third at hand, which the article describes as your liquid or safe holdings, things you can access easily if you need to. This is your cash, your government bonds, those are considered pretty safe, or even gold, which has historically been a haven when things get really rough in the economy.
I see. So the basic idea here, and the article really stresses this, is to avoid putting all your eggs in one basket, right? You don't want to be overly concentrated in a single asset, because if that asset takes a hit, your whole portfolio suffers. You want to spread the risk. And the reason that makes so much sense is that different types of assets, they don't always move in the same direction at the same time. So if one part of your portfolio is struggling, another part might be doing just fine, and that helps to cushion the blow.
And it's not just about logic either, it's about human psychology. I mean, we're all prone to biases, right? We tend to favor the familiar, or maybe we get overly excited about an asset that's been doing really well recently. This Talmudic diversification, it forces us to step back and be more rational, more balanced in how we approach our investments.
Absolutely. Like a built-in safety mechanism against our own, sometimes irrational exuberance. All right, let's move on to the second principle, which the article calls preserve capital before seeking profit.
And this one starts with a quote that really made me stop and think. It's from the Talmud again, and it says, "He who wishes to become rich should pursue loss." Now, at first glance, that sounds a little backwards, doesn't it?
It definitely does, but the article goes on to clarify, it's not about actually trying to lose money,
Thank goodness.
but rather, especially when markets are turbulent like they are now, it's about making the preservation of your capital what you already have, your top priority. Even if that means potentially sacrificing some potential for big gains, especially if those gains come with a lot of risk. You see, in a chaotic environment, your first job is to protect what you have, to make sure you don't get wiped out.
That makes a lot of sense. And there's that famous saying in investing, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And the article gives some really practical examples of what this might look like in the real world, in your actual portfolio. Things like tilting towards stocks that are considered more stable, more defensive.
Yeah, like companies and sectors that are kind of essential no matter what's happening in the economy. Think utilities,
Yeah.
healthcare. People always need those services, so those companies tend to hold up better during downturns.
Precisely. It's not about getting fancy or chasing the latest hot trend. It's about being strategic and playing good defense.
Right. And the article also mentions increasing your allocation to dividend-producing ETFs.
Oh, ETFs.
Yeah, those exchange-traded funds, they hold a basket of stocks, and they distribute a portion of their profits regularly to investors, so you get a steady stream of income. Or you could even look into covered call ETFs. Now, these are a little more complex, but basically, they could generate income while also offering some protection against losses if the market goes down. And then, of course, there's always the option of holding more cash or short-term bonds, the really liquid kind. These not only provide a cushion if the market takes a dive, but they also give you flexibility, dry powder to jump in and buy if things get really cheap and you see an opportunity.
I like that, the dry powder analogy. It's about being opportunistic, being ready to strike when everyone else is running for the hills. And, I think this principle also speaks to the emotional side of investing, which is often overlooked. Losses, they tend to sting more than gains feel good. It's just human nature. So by focusing on preserving capital, on not losing money, we can actually make more rational long-term decisions. We don't get spooked as easily.
Very true. It helps you stay the course, ride out the storm, and come out stronger on the other side.
And the article has a great line about that. Something like, risk-managed patience is more Jewish than short-term speculation. It's about taking that longer view, resisting the temptation to get swept up in the hype and the noise of the market.
Exactly. And that leads us to the third principle, which is pretty straightforward, but so important, especially now. Avoid excessive debt or leverage.
And for this one, the article quotes Proverbs, which says, the borrower is a slave to the lender. There's no sugarcoating that, right?
Nope. It's a pretty stark warning. And look, we all know that using borrowed money, leverage, can juice your returns if things are going well. But the flip side is that if the market turns south, those losses get magnified big time. And if you're over-leveraged, you might even be forced to sell assets at the worst possible time just to cover your debts. You completely lose control.
Yeah, it's like playing with fire. And the article makes a strong case for why minimizing debt, especially in uncertain economic times, is so crucial. It allows you to maintain control over your investment decisions. You're not at the mercy of someone else, some lender who might be calling in their loans when you least expect it.
And, there's a broader point here about financial independence. It's a recurring theme in Jewish thought, especially in the context of overcoming challenges and adversity. The idea is that if you're free from excessive debt, you have more options, more flexibility to navigate whatever life throws at you.
Exactly. You're not beholden to anyone. And that peace of mind, that sense of autonomy, it's invaluable. So practically speaking, what's the advice here? The article suggests using margin. That's when you borrow from your brokerage to buy more stock very, very cautiously, if at all. It's just too risky when the market is as volatile as it is right now.
Yeah, you're just asking for trouble. All right, on to principle number 4, which is invest ethically and honestly. This one connects to a quote from Deuteronomy about using a full and just weight in all your dealings. It's about fairness, about integrity.
And what's so fascinating here is how the article links these ancient ethical teachings to modern investing practices. In Jewish law, in halacha, deceit and unfair trade, they're strictly prohibited. And the article argues that even in the world of finance, where competition can be fierce, these ethical principles shouldn't be compromised.
That's a powerful message. It's like saying, hey, just because everyone else is cutting corners doesn't mean you have to.
Right. So how do we put this into practice when we're making investment decisions? Well, the article suggests that we need to think about more than just maximizing our potential returns. We need to consider the ethical implications of where our money is going.
Right. It's not just about making a buck. It's about being responsible with your capital.
Exactly. So we need to avoid investments that involve outright fraud, that's obvious, but we should also be wary of profiting from the misfortunes of others or investing in companies or products that seem inherently exploitative.
Right. So it's not just about avoiding the bad stuff. It's about actively seeking out the good stuff. The article recommends supporting companies that have strong ethical governance, that operate in a sustainable way, that have a demonstrated track record of integrity. Companies that are doing things the right way for the right reasons.
Yeah, and I love that. It's a powerful reminder that investing isn't just about numbers on a spreadsheet. It's about aligning our financial actions with our values, our sense of what's right and wrong. It's about using our capital to make the world a little bit better, a little bit more just.
It's a pretty powerful idea. Okay, ready for principle number 5?
Bring it on.
This one emphasizes taking a long-term view. It's called think generationally, not quarter to quarter. And the quote that goes along with it from Midrash Tanshuma is quite profound. A person must think not only of himself, but of his children and grandchildren.
That really challenges us to expand our perspective, doesn't it? It's about building wealth and security that goes beyond our own immediate needs. It's about thinking about future generations.
Right. It's about leaving a legacy, not just a pile of money.
And this long-term orientation, it changes how we invest. The article talks about investing with a multi-decade horizon, not getting caught up in the short-term ups and downs of the market or obsessing over quarterly earnings reports. It's about embracing the power of compounding returns over time.
Yeah, time is your greatest ally in investing.
And it leads to building a portfolio that's designed for longevity. So things like dividend growth stocks, companies that consistently increase their dividends over time, real assets that tend to hold their value over the long run, and investments that protect against inflation so your purchasing power doesn't erode over time.
Those are all smart choices for a multi-generational portfolio. It's about preserving wealth, not just for ourselves, but for our children and our children's children. It's about ensuring that the wealth we build can withstand whatever economic challenges might come their way.
It's a really profound idea, especially when the present seems so uncertain. All right, principle number 6 is a very practical one. Always maintain a store of liquid assets. And for this one, the article goes all the way back to the story of Joseph in the book of Genesis, who wisely stored grain during years of plenty so he'd be prepared for the inevitable famine.
Yeah, that's a classic example of foresight, of being prepared for the unexpected. And in today's world, that translates into what the article calls a financial ark.
A financial ark, I love that.
Yeah, it's basically a readily accessible reserve of emergency cash or assets that you can easily convert into cash if you need to. And this ark serves two really important purposes, especially when things are volatile. First, it's your safety net, your buffer against financial shocks. It could be a job loss, a medical emergency, who knows?
Right, life happens.
Exactly. But then, and this is the part that's especially relevant to investing, it also gives you the financial firepower to take advantage of market downturns. So when everyone else is panicking and selling their stocks, you have the cash to step in and buy those assets at bargain prices. You're essentially turning a crisis into an opportunity.
It's like having the courage to be greedy when everyone else is fearful, as Warren Buffett says. And it's not just about seizing opportunities either. It's about having peace of mind, knowing that you have the resources to weather whatever storm might come your way. And the article points out that this tradition of saving for a rainy day, well, it's deeply ingrained in Jewish thought. It's about being prudent, about preparing for the inevitable challenges that life throws at us.
Absolutely. All right, we've arrived at the final principle, principle number 7. Trust in action, not prediction. And the quote for this one comes from Pirkei Avot, and it says, "You are not obligated to complete the work, but neither are you free to abandon it." Now, how does that apply to investing, you might ask?
Well, I think it's incredibly relevant in today's world, where we're constantly bombarded with market forecasts and predictions about the economy. And the problem is that these predictions are often wrong, and they often contradict each other, which can leave us feeling paralyzed, not knowing what to do.
Yeah, information overload, analysis paralysis.
Exactly. And this principle, it's basically saying, hey, you don't need to have all the answers. You don't need to be able to predict the future. No one can do that consistently.
Right, because the market is inherently unpredictable. If it was predictable, we'd all be rich.
Precisely. So what should we do? Well, the article emphasizes the importance of making disciplined, rational decisions and taking consistent action rather than trying to time the market perfectly or guess what's going to happen next. Because trying to time the market, it's incredibly difficult and it often leads to more mistakes than successes.
Yeah, you end up buying high and selling low, which is the opposite of what you want to do.
And the practical takeaway here is to continue investing regularly no matter what the market is doing. Dollar cost averaging is a great way to do this. You just invest a fixed amount of money at regular intervals, whether the market is up or down.
Yeah, it's a simple but effective way to take the emotion out of investing.
And over time, this helps to smooth out your average purchase price. But it's also important to be willing to adjust your risk exposure as needed based on what's actually happening in the market and your own personal circumstances. You don't want to just set it and forget it. You need to stay engaged, make adjustments as needed, but not react impulsively to every headline or every swing in the market. It's about being thoughtful and proactive, not reactive and emotional.
So there you have it. We've gone through all 7 Jewish investing principles for navigating turbulent times. To recap, it's about diversification, preserving your capital, avoiding excessive debt, investing ethically, thinking long-term, maintaining liquidity, and focusing on action over prediction.
It's remarkable how these principles, many of which have been around for centuries, are still so relevant today. They offer a really solid framework for navigating the complexities and uncertainties of the market, and they emphasize resilience, a long-term perspective, and a sense of responsibility that goes beyond just individual gain. It's about investing with integrity and a sense of purpose.
Couldn't have said it better myself.
Yeah.
And now we have a final question for you, for all of you listening. As you think about your own approach to investing, your own financial journey, which of these principles resonate most strongly with you? And how might you apply them in your own life, given your specific goals and circumstances? And perhaps even more importantly, what would building your own financial arc look like for you? A source of security and strength to help you weather any storm. Those are some questions worth pondering, and we encourage you to do just that.
Absolutely. Thanks for joining us on this deep dive. Until next time, happy investing.
Take care.